Good morning, everyone. Welcome to November's investment update. We're going to cover most of the month of October, and a lot of the data is from the end of October, but clearly a lot has happened in November. We've got the resolution of the election, and we've also got the news about the potential vaccine. So we will also touch on that as well. Let's keep going. Okay, I'll start with fixed income returns. We've seen throughout this year the flight to safety that we've had in government bonds, and then as we've discussed in prior investment updates, that is now stretched in terms of how much further that can go, and really we've seen those weaken in the last few months as November's news has come through with potentially a vaccine and a move towards more normal return to life. We've seen that those government bonds have come off even further and have retreated a little bit as people have started to think about re-embracing risk assets. Investment grade bonds, you can see they've recovered very strongly from the sell-off that they had in March. They're yielding about 2% above what government bonds yield, and then high yield, still plenty of risk premium in high yield bonds there, so providing you pick the right high yield bonds, potentially good returns for high yield, but I would caveat that you have to pick the right bonds. I want to focus a little bit more on equities in this session. In particular, we're going to talk about the short-term outlook for equities and then expand that time horizon to think about what the returns might be for longer-term investors. Here, I've also talked before about underneath the market, there's been sort of two different stock markets. One stock market for large cap companies who have been relatively insulated from the economic problems of COVID, and the other market for companies who are really struggling with this stop-start economy, thinking about how can they make sure they get through this tough period into the other side. And one way to visualize this is two different market indices. One, the MSCI All Country World Index, so that's the black line here. That represents all global stocks all over the world, but weighted by market capitalization. So those biggest stocks, the Googles, the Microsofts of the world, they have a larger proportion of impact on what that index is going to do. And then another way to look at it is an equal weighted measure of those stocks. So this is where all of the smaller companies can start to come through, and you can see how their performance is versus the bigger cousins in their market cap weighted industry, that market capitalization weighted. And what you see back in 2017, when everything was hunky-dory, we had this globally synchronized economic recovery, very much led by the stimulus of the tax cuts that Donald Trump had put in place. We saw large cap companies do very well, but also we saw small cap companies do well. It was very much a case of good economic backdrop is lifting all boats. And then as that came to an end and markets started to realize that interest rates might go up, that possibly the economy might slow down as the next step, we started to see large cap companies that are more defensive start to outperform their equally weighted cousins. And really this has been exacerbated as we hit the COVID. So you'll see large cap indices really very much back to highs, whereas equal weighted index struggling a little bit and not as powerful. And how your portfolio would have done is very much dependent on how much of these winning, these small number of stocks that have done very, very well, how much of that you've had in your portfolio. And we've definitely participated in that rally. We have over recent months been selling down some of these stocks. So you'll see us reducing some of the weight in some of the tech stocks, despite the fact that they're really good businesses, and we had been rotating into smaller companies that should benefit from an eventual recovery. You might have also seen indications of the difference in valuation between growth stocks and valuation stocks, how that became to be quite an extreme. And really what we saw in November was a bit of a snapback on that as the COVID news came out. Just shifting gears for a moment, just getting back to the core of how we look at things, this valuation. We go through this exercise once a month. We think about buying a basket of equities, that large cap weighted market cap, holding them for 3 years, collecting those dividends, and then at the end of the period selling out at some sort of valuation measure. Now, we normally focus on that 16 times multiple as something which has been historically a good average of what valuation multiples tend to be. But it's definitely possible that, in a market where it's difficult to find returns in government bonds and people are being forced to take a little bit more risk, if we get a recovery in earnings and that happens, people could remain quite comfortable with equities, and that rich elevated valuation might maintain, in which case we get sort of 4 to 6% return potential from that, as I said, that broad basket of companies, which is not necessarily representative of the opportunity set. So we come away from this with a conclusion that yes, valuations are elevated, and our expectations in the short term should be fairly modest, but we also got to recognize that there's that opportunity to do some stock picking further down in the smaller cap area. And when I say smaller cap, I'm not really talking about really small companies. Even if you just move out of the mega large caps, there's plenty of scope in large companies to pick stocks there. So here, this is updated to include November. So this is a growth versus value look on that same concept of the winners versus the losers. You can see from April, March there, very, very strong recovery, back actually exceeding the high. So those growth stocks, anything that has a business model which is insulated and protected from what's going on, has a real long runway of growth, has surged not back to prices that they were before COVID hit our economies, but actually exceeded that and done even better. Meanwhile, cheaper stocks, and of course value is often representative of risks that people can perceive. So cheaper stocks, those stocks that are struggling with the stop-start economy, they've bounced back a little bit, but actually remain below their highs. And there are a lot of stocks that haven't yet fully recovered. And of course, the opportunity is, as we get a vaccine and move back to normal, some of those could recover back to the highs. And you'll hear a lot of talk recently about a rotation from growth into value, people selling some of the winners that they've had in the growth stocks, and then moving into some of the stocks that stand to benefit from the recovery. Very, very strong move that we saw at the start of November as that started to pick up pace. And I want to put that into the context of sort of a longer history. If we look at this as, so the top line shows the outperformance of that growth versus value. This is looking at the large cap stocks in the US here. So there's growth winning stocks versus the cheaper stocks where there's concern over the economy's impact. You can look at the daily movements on the chart below, and you can see historically they were quite small, so the difference would have been maybe 1% a day. Sometimes value stocks would do better than growth stocks, sometimes the other way around. And then as we picked up into March, you can see that difference started to get exacerbated. So on a daily basis, the winners and the losers were more determined by, are you a COVID winner or a COVID loser, to use that simple jargon there. And then what happened when Pfizer came out on Monday and said that they had a vaccine which was very effective and could possibly be a solution to our problems? We saw really an outsized move, kind of a 15 standard deviation move as the market was really taken a little bit wrong-footed. It got a little bit complacent about where it needed to be positioned and how it needed to be positioned, and a move that really I think would have taken a lot of people by surprise, and possibly is one that indicates some kind of regime change. So we get a little bit of an insight into, if we were to develop an effective vaccine, or at least one that could protect the vulnerable in society and enable us to get back to a little bit more of a normal working practice, what kind of an impact would that have on the stock market? And it potentially could be pretty big. Now, I think with all things, we shouldn't get carried away by this thing. It's still going to be stop-start. It's possibly possible that this particular vaccine isn't the one that cures all of our problems. But I think one thing that we can be relatively sure about is that we are going to find some sort of solution to this. Maybe there's a lot of vaccines that are in the running. There's obviously different ways that we can use them. It's not necessarily even that everybody has to get vaccinated. If we just vaccinate the sick and the vulnerable, then that goes a long way to helping get back to normal. People tend to take these things to extremes and then think, okay, now I have to switch all of my stocks into the recovery stocks. Managing your investments is all about balance. As that complacency has grown in sort of the COVID winners, the right thing to do was to slowly move out of them and move into stocks that had the potential upside. And this is going back to what I was saying at the start. That exercise we do from a top-down perspective on the index as a whole, that's picking up the stretched nature of some of the growth stocks, how it's going to be harder for them to deliver. Even if they deliver on their business plans, a lot of it is priced in already. But if you dig under the surface, you can hopefully pick up some other companies that stand a good chance of giving some good returns there. Because the other big news flow in November was the election result, and it's worth touching on that, what it means for markets, understanding why markets have reacted the way they have. So it seems, I guess it's not 100% certain. I was reading today that there's still on the betting odds an 18% chance that Trump might win. But I think at this point we can take it for granted that Biden has won the US presidency. But the interesting thing is how people voted in the Senate. So whilst it seems that people were very much coming to a consensus that they needed a change of leadership, a change of representation on the world stage, it's not that they wanted to necessarily adopt all of the Democrats' policies. And the fact that Americans have really voted for the Republicans to keep control of the Senate means it's going to be a lot harder for the Democrats to push through some of their policies. And if you look at a lot of their policies, they were actually quite negative for the stock market. So the fact that they want to put up taxes quite significantly, and I'll get to that in the next slide, that's negative for the stock market, just as we saw the huge rise in 2017, that steady grind upwards that floated all boats. That was mainly as a result of both an economic recovery synchronized globally, but also the reduction in taxes that benefits equity holders. An increase in taxes would reverse that and put that the other way. Healthcare is always an area of the market that is subject to political interference. The Democrats have an agenda of trying to widen out availability of healthcare, which is a noble cause. But one of the risks to investors would be, how does that flow through into the earnings of different healthcare companies? One of the risks out there was that some of those profits might get regulated away or taxed away by various initiatives that may be put in place. But without control of the Senate, that becomes a lot harder to do. So investors in the healthcare stocks relieved a bit of a sigh of relief. Equally with technology, a lot of talk about how dominant these tech stocks are, the need for regulation, the need to protect everybody, the need for politicians who feel that they've lost control of the narrative. Sometimes they want to regain that, so they want to regulate what kind of news technology companies can display and show and how they do that. Again, with a Senate that isn't controlled by the same party that has the presidency, that regulation becomes a lot harder to push through in a way that's favorable to one party and gives a bit of gridlock. And gridlock is good for stocks when it comes to this kind of regulation. It also puts a lot more power into the hands of the companies who can lobby various senators and try and buy the votes as they do. On trade, it's another positive. So Donald Trump has been quite antagonistic towards both China and Europe. So we get the potential of an improvement in relations there. So that hopefully might ease the stress on trade. And the one thing everybody agrees on is the need for stimulus. Whether it does actually stimulate the economy in the long run, I think, is up for debate. But in the short term, clearly sending checks to people that they spend is good for companies generally, and the market sees that as a positive. And definitely the Federal Reserve is behind to support that. So for these aspects here, I would say are positive. The taxes side of it, I think, has the risk there is reduced, but I don't think it's gone away, and we still need to be careful of that. This is just a quick recap on some of the things that were changed when Trump got elected, and some of the things that Biden was proposing to reinstigate. So the top one there, corporation tax. A lot of corporations in the US, especially ones with a domestic focus, would have paid about 35% corporation tax. This is quite a lot higher than many countries have in the world. In the UK, it's more like 20%. So Donald Trump introduced a flat rate of 21%. So that was a huge tax cut for a lot of corporations. What Joe Biden's proposing is to put that back up to 28%. So that really undoes the tax cut that Trump introduced in 2017. Small businesses, Donald Trump introduced a tax-free, 20% tax-free income for small businesses. That tax break would get repealed under Biden. Minimum taxes, this is probably for people who don't live in the US, that they're wondering what this is. One of the things you do when you fill in your tax return, you fill it in under one set of rules and you calculate how much you owe, and then you do the whole exercise again under an alternative tax code. So you redo it with different set of tax rules, and then if that number is higher, then that becomes the tax that you pay. This alternative minimum tax was introduced in the 1970s as a way to try and get more tax take out of people, because they found that even though they'd increased tax levels to quite punitive levels, they weren't getting the income that they thought they would get, because a lot of people were now, when tax rates go to sort of 75% or so, a lot of people spend a lot of time trying to figure out, well, how do I keep what I've earned? So effort and resources is diverted from producing consumer goods and services to trying to keep what the profits that you already made. So that was repealed. That is less red tape, less burdensome compliance for everyone. Biden is proposing to kind of put that back in and have a minimum tax once more. On the income tax, he reduced taxes for all Americans earning income. That was going to be repealed as well. And capital gains tax, it was 20% for top earners. That would go up to nearly 40%. So a huge increase in capital gains tax. All of these things are negative for the stock market. And whether they're good for the economy or the society is a different question. But in terms of the stock market, they're definitely negative. Now, it is true that at present, the market is taking the view that these are going to be harder for Joe Biden to put through, but they're not impossible for him to put through. And he was definitely elected under this mandate, so he would think that this is part of his job to do this over the next 4 years. He probably also would not want to do this immediately. His first course of business is likely to get the stimulus through. So I think we've got a bit of time before this starts to be talked about in the media and in the news wires. I think the first thing is the stimulus. But as we move on sort of a year down the road, maybe a year and a half down the road, I think this becomes probably back on the agenda. And the question becomes, how many of those Republican senators would be willing to vote some of this through in exchange for, say, a new military base in their state, or in exchange for some local tax breaks or federal tax money to flow back into their state. So it's definitely possible that some of the Republican senators could effectively be bought off to push through some of this tax increases. So whilst the risk is diminished, I do think it is still a risk, and it's still something that we're looking at and considering as we choose the companies that we're invested in. I want to now talk about longer term returns. When we look at our tactical asset allocation, we are very much thinking with a 3-year hat on, and we're trying to think about, over that period, what are the risks that we have to manage and what are the potential returns that we might get. And there are times, as there were back in March, when that flags very clearly that the potential returns are quite high, and there are times like now when it flags that actually the returns potential are quite muted. But it's worth bearing in mind the degree of certainty we have around those forecasts and around that analysis. This chart shows the US stock market. So it's the S&P 500 stock market, and it shows the returns you would have got holding for 1 year. That's the light blue line in the background there. It goes all the way back to 1928, so there's nearly 100 years of history here. And what you can see is that on a 1-year basis, pretty much anything can happen in markets. You've got returns plus 50%, you've got returns minus 30%. It's kind of all over the place. Yes, it averages to a positive number. You can see it tends to be coming in at around 8%, that if you were to draw an average line through there, but it's very much, I'm not going to say random, but it's very much uncertain. It's very volatile. Now, as you extend your time horizon and as you decide to hold not just for 1 year, but let's say for 15 years, the return that you get from any particular time for buying and holding for 15 years becomes a lot more certain. And that dark blue line is that 15-year return that you would have got at any period in time. Now, there are still good times and bad times to invest. You can see that in the 1960s, that was a fairly bad time to invest. You got close to zero return. And in the 1980s, that was a very good time to invest. You got 15% or so annualized 15-year returns. But it's generally positive. And in fact, over this nearly 100 years of history, 90% of the time, those 15-year returns have been positive. So if you're thinking about crafting a long-term investment solution that has that kind of time frame, well, what better starting point than one that has delivered positive returns 90% of the time? Now, there are outliers. That very, very first starting point, you can see if you bought at the peak of the economic boom in 1928, just before the Great Depression, and then you endured the Great Depression, and then you sold out at the sort of towards the end of the Second World War, then you had a bad outcome, you lost money. But that's a fairly extreme scenario, unless you think that in 15 years' time, we're going to be in some world war and that we're going to have a huge depression in the interim. I think that we should sort of, to some degree, take that off the table. All the other times we've had positive returns. Now, we do this exercise to sort of guide to what those returns might be on a 15-year basis. And as I said, the certainty we have here, because the good years tend to average out with the bad years, and valuations are a lot more powerful the longer your time horizon. We find that the certainty we have here is a lot greater than the certainty we have on a 1 year or a 3 year basis. So going back to those comments I had, at the moment, valuations are expensive in the short term, and we see that the next 3 years we should moderate our expectations. But as you start to lengthen that time horizon out, you see that for equities, that expected return is currently sitting around 6.5%, let's call it. Now, that's below the range of history. So history has been between 0 and 15%, or 0 and 16%, kind of averaging around 8%. So it's less than the 8% that you would expect. It's a little bit lower, but it's still positive. And if you compare it to other asset classes there, so government bonds, pretty much you're going to get 0 at this point. Investment grade bonds, you'll get maybe 2%, and then high yield a little bit more. Any investor looking at a 15-year horizon from here and thinking about a buy and hold strategy, equities become the asset class that is the most attractive, even though in the short term, they are a little bit expensive, and that risks are a little bit higher of a pullback. I just want to make it clear so we refresh our long-term expected numbers once a year. We do that in Q1. The intention is not to update those numbers. This was just an interesting exercise to see, okay, equities, they seem to be a bit expensive right now. How would that feed through into our long-term expectations if we were to rerun those numbers at the moment? So I'm not suggesting that we update our literature or we change what we're using for planning. It's just more an interesting exercise to understand where they might sit at the moment. We often get the question, should I invest in the market right now? And of course, the answer to that question really is, well, it depends on your time frame. If your time frame is very short and you're only thinking about the next 1 year or 3 years, then investing now, isn't a great opportunity. But if your investment time is longer than that, it's 15 years, then you have the choice really of accepting those long-term returns, which are a little bit below average, or sitting on the sidelines and hoping that things improve. And it may, but it may not. What you can say is that there's a high degree of certainty that you'll get that kind of 6% plus for equities over 15 years. But clearly in the short term, that uncertainty and the variation becomes a lot higher. So, I mean, just to summarize here, well, I've kind of already said it, but really your choice is, do you accept those long-term returns, or do you watch from the sidelines in the hope that things improve? And I think one thing that we should note is that as this week has shown, markets have rallied about 8% or so this week, and that's really a year's worth of return that you've had in 1 week. So if you're sitting on the sidelines and you've said, okay, these long-term returns, they're a little bit lower than what I want, I'm only going to get 6.5%. I really want that 8%. I'll just wait until a better opportunity comes around. And then we get a vaccine, and then the market situation improves and things remain expensive. You're left sitting on the sideline watching other people make money, but with this awkward now decision of, okay, what do I do now? And the risk is that you sort of never get invested and you miss out on those long-term returns because you're always too fearful of the short term. Moving to portfolio activity, how we've been investing and what kind of returns we've had in October. Here's the portfolio as it stood on November the 10th. You can see we've decreased our government bond weighting quite significantly, and we've started to invest in a variety of shorter term bonds. So government bonds has come down a little bit there. Other than that, widely diversified in different regions, and yeah, so that's the portfolio. Trading wise in October, we did 2 things to change the target, and then I think probably I should add philosophically what we were doing through the month. It was trying to take advantage of the market weakness in the other shares that we still had a lot of conviction in. So Ørsted, the Danish company that makes the offshore wind farms, fantastic company, really good growth prospects, really good long runway of 30 years maybe plus of installing wind farms, being able to operate those wind farms, generate profits. A lot of investors know about this now. They're aware of it. The huge push that you've seen generally for and talk around ESG has even highlighted this company even more. It's bid up the prices quite significantly. We've made huge returns from our investment in Ørsted. And as we just look at that valuation, it starts to fall for us in that camp of those growth stocks that have run really hard, where valuations are extended. Is this going to be the type of stock that really generates returns for the next couple of years, or do we need to get some more of those kind of recovery stocks in place, stocks that can benefit from the economy getting turned back on? So whilst we still very much believe that Ørsted is going to deliver on its business plan and hit its targets, because we think that we've effectively made a lot of that money already and the risks have increased because the valuation is higher, we sold on that basis. Equally, Cognizant, tech company there, one of the companies that's recovered quite strongly, we sold that for a similar reason. So still fairly confident that Cognizant can execute its business plan. There's a bit more execution risk with Cognizant, so our conviction isn't quite as much there, but the valuation support no longer there, so we sold those 2 stocks. Now, we didn't replace them straight away. We have since we've purchased this month Electronic Arts, a gaming company that makes computer games, and also we've added to one of our healthcare names. But what we did do is we made sure that all of the other companies that we have in the portfolio, as markets were weak, we religiously topped those up, bought on weakness, and made sure that we're in a good position for when that news flow turned around, which it has done in November, that we've benefited from that. So you'll see as markets came down in October, that weakness that was broad-based with concern about the election, with concern about what might happen on the political side, where that provided opportunity in those companies where we still see the valuation as solid, and we see good companies able to execute their business plan. We just kept buying those companies, making sure we had the right weight in them to benefit from when sentiment turned around as it did in November so far. So October, looking at the month, if you might remember from that first chart I showed, equities were weak. They fell about 4%. That's fed through into the portfolio here. So this looks at the cautious fund, which sits roughly 50% bonds, 50% equities, as you can see from the average portfolio weights there. So on the equity side, we did suffer from the pullback in markets. As I said, that did give us the opportunity to top up in names that we like and make sure we had representation there for the subsequent bounce back that we've seen in November. So November's numbers will be very different from these. Whilst these are negative, November should be, well, I guess the month isn't closed yet, but should be positive. So equities falling about 3.8% for our portfolio. The UK stocks getting hit a little bit more disproportionately, so they fell 5%. Within our UK stock selection, we tend to have some stocks that would benefit a little bit more from the recovery, a bit more cyclical stocks there. Again, this is about getting the right balance in the portfolio, making sure that you've got enough of that cyclical recovery exposure, but in a safe way so that we can benefit no matter how long it takes for that recovery to manifest. But they do tend to move around from month to month. Our infrastructure investment and our property being a bit more resilient, so only falling slightly there. And then on fixed income doing what we would want it to do, being that steady eddy, that balance of the portfolio. So we actually made money in fixed income that contributed positively to returns, albeit only quite small. With strangely enough, our high yield investments doing quite well. So a couple of bonds there being rewarded, particularly I think the financials that we have, bonds for financial companies did quite well in the month of October. But government bonds were a little bit down and investment grade was a bit flat. Just looking at individual stocks underneath the hood, how they performed in October. We had Alphabet and Tencent, so two technology companies at the top. You'll find that they may be at the bottom next month, and this list will reverse slightly. So things like Prudential in the UK, that was a loser in October, up very, very strongly in November. So Cognizant's in red there as we sold it. Orsted also in red there as that was sold. Orsted was up 12% on the month. That catalyst of stock doing very well, prompting us to revisit whether it still earned its way into the portfolio. On the bond side, investment grade, you'll see a Phoenix bond and a Daimler bond there, two fairly short dated bonds. They mature in 2022. So that's part of our bond ladder that we've been constructing to diversify away from government bonds, reduce the risk that if yields rise, as they happen to have done this month, that we wouldn't lose money on our government bonds. And that Fidelity bond in red, we didn't sell that, it actually matured. So that matured in the month and we got our money back to be reinvested elsewhere. But winners, very much the tech companies, so Alphabet, Tencent at the top, also Alibaba, which was did quite well in the month. And then on the UK, Howden Joinery. Howden Joinery, worth saying, a bit of an anomaly. Howden had come to the market a while back and said that its business was going really well. It was actually taking market share. It's very strongly positioned. And immediately after that, investors didn't really react to that too much. In fact, the shares sort of drifted down slightly, despite the fact that they'd come out with a very positive statement. And then in October, for some reason, the market decided to sort of revisit that and say, well, actually, yeah, this is a really good company. It's doing very well. It's taking market share. We should buy that. And the shares had a very, very strong run. Whereas some of the other more domestically focused companies didn't move so much in the month. So I like it when stocks move around in a slightly different fashion. It gives us opportunities to add and shift the weights around. So just as we were trimming back Howden Joinery slightly, as that share did very well, that allowed us to invest in things like Taylor Wimpey. And then this month we've seen Taylor Wimpey surge quite strongly, but Howden's actually lagged because it had already run up into that. So again, we get the opportunity to cycle some capital out of Taylor Wimpey back into Howden, hopefully adding value at the edges there. Yeah, I think that's that. Yeah, and then just on the high yield, you can see that Lloyds and Barclays at the top there, up nearly 3% for the Lloyds bonds and 1.6% for Barclays, as people became a lot more comfortable with the banking situation. So in October, the news that came out from as banks started reporting earnings and loan loss provisions, it became clear that those loan loss provisions weren't as high as people had feared, and actually that the banking system was coping quite well with the economic stress that had been put on corporations and their ability to pay back debt. So whilst there were bad loans, it wasn't as bad as people feared, and that took the pressure off some of the bank stocks. Not necessarily the equities at that point, but the bondholders became a lot more relaxed and bid up those bonds. Just looking at performance, I think it's fair to say this year that we've done a lot better in the more defensive bond-heavy parts of the portfolio. Within the more equity-sensitive risk grades, stock selection has been quite difficult. As I mentioned, one of the features of this market has been that the number of companies that have been winners has actually been few and far between. And really to sort of keep up with equity indices, you had to have quite large weights in a small number of stocks. And if you diversified away from that and you were looking to play some of these recovery stocks, even if they weren't distressed themselves, it can make stock selection a little bit more challenging. So stock selection can come in fits and bouts. We've seen periods of time before where, when we have lagged on equity stock selection, it tends to be quite small. But then when we make it up, we get a sort of big jump, which we've seen in November. So it's kind of part and parcel. You've got to stick to what you're doing. And then in the long term, you find out the results come true, as we see in the charts to follow. So maybe I'll go to the growth one, actually. So this shows the performance of our growth strategy, so our high net worth model that we've been running since 2014. And then as we launched the fund in March, how the fund has done. So again, our real plan here is let's make that strategic asset allocation, a really well designed building block to start with, something that can deliver that long-term outcome, that 15-year performance, and then make sure that we do all that we can around that to manage those risks and take opportunities where they come. So all of the work we do on our tactical asset allocation, on our stock selection is designed to add that extra little bit of value that hopefully compensates for the fees that are charged, and also add some value on top of that. And you can see historically, we've done that, and this year has been an okay year, but not necessarily, I say, a great year. I think it would have been nice to get a bit more juice from the stock selection there. But as I say, really pleased with the fixed income side of the portfolio, and the equity side doing okay, but potentially could do a lot better. And I think the stocks that we have remain well positioned for the market that we're in, seeking out value, looking for good businesses that can compound over time. And in the short term, as those one-year charts say, anything can happen, but in the long term, that value and those good businesses start to win out. So that's presentation for November. I will see if there's any questions. Oh, we've got Christopher Dean there. Hi, Lawrence. Not quite sure how that's happened, but okay. Questions. Can you please send out a recording quickly to send on to both existing and potential clients? Yes, the team will try and package that up as quickly as possible and send that on. So hopefully we'll get that out as soon as we can. We might find a way to try and edit out Lawrence, but oops. Question from Rory on Sanlam Accel Income. I don't manage that fund, so I'm probably not best placed to answer that question, but I can talk generically about income versus growth. So the question is that predominantly value stocks compared to growth stocks, thus explaining the underperformance of that product? Value stocks have struggled, as I've shown in those charts, and income paying stocks tend to to fall into that value camp. So if you've really, sort of pushed your portfolio to dividend focused companies, they tend to be the companies that have lower growth opportunities. That's why they're paying dividends back rather than reinvesting in their business. One of the features of this market has been that those companies have struggled. So yes, if you've had a dividend focused strategy, that hasn't been the right place to be. What is the outlook for the Euro and European markets? So we remain concerned about the US dollar's position versus other currencies. And the euro is the main balance of that. So if you look at the US dollar index, it's trade weighted index. The euro is a big portion, nearly over half of that basket. I still think the euro looks like it should appreciate versus the US dollar. It's cheap on a purchasing parity basis. I also think there's some good reasons why, because it's got trade surpluses rather than trade deficits, that the euro should appreciate. So it's not a strong enough conviction call that we can necessarily make money off of that by putting on instruments that would benefit from that. But equally, it's something that we've at the edges rotated the stocks that we've got to make sure that we're in the right place should that impact different companies. So you have to look into the company themselves to see how they would benefit from euro strength versus dollar weakness. But we've done that work and we've positioned appropriately. Do the next 17 years post 2003 look different? When we talk to clients and write reports, we often talk about timeframes of less than 15 years. If we made a company one, okay. Do the next 17 years look different? I'm not quite sure what the question is, to be honest. The longer your time frame, the longer your investment time frame, the more certain you can be that good years will wash out with bad years. I mean, that kind of law of averaging just works in your favor. The shorter your investment time frame, you've got to consider whether those risks are going to be appropriate, I guess. You lose that power of certainty. Having a longer term time frame just gives you a bit more of luxury. It gives you an ability to take risks, gives you ability to sort of withstand that more short-term volatility. So I think if your time frame is a lot shorter, then you should put more emphasis on our shorter term concerns of market valuations. If your time frame is longer, then you should probably put more emphasis on the ability of equities over the long term to be the winning asset class. There's a comment over Craig's fund there. It's not really for me to comment on that. It's more a question for Peter, so I'll leave that. Is there any particular recovery stocks that you've got your eye on at the moment? Well, the two that we have that really do benefit would be Booking, which owns Booking.com, OpenTable, that kind of stuff. And it would also be Intercontinental Hotels. And they're both interesting companies for two different reasons. So Intercontinental Hotels is interesting because it's got a very strong pathway to growth. It can grow the number of hotels that it has in China. It's got a really good business model with its franchise business model, where it doesn't own the hotels itself, but owners of hotels kind of plug into their network. So we really like its ability to grow without a lot of capital being needed, and that as holidays recover and as hotels recover, it should benefit from that. And it's also because it's got net cash on the balance sheet, it's got strong cash position, it can weather that in the short term. The other one, Booking, bizarrely enough, Booking's competitive strength has probably improved. So as a lot of companies have struggled, we've seen it's continued to take market share, and so even as we come out of this, it should be a stronger company because some of the competition has fallen away. And I guess you'll see that more generally. So the companies that do survive in those cyclical sectors, they should benefit from less competition. They should benefit from a stronger market position. So those are the kind of winners that you want to get, those relative winners within the recovery side of it. Now, it is true, if you delve into some of the more distressed people that happen to sort of limp on by, they will probably have quite good share price recoveries in the short term, but they won't necessarily be better placed in the long term. So our strategy is to pick those longer term winners that can very easily make it through the short term, and then rely on those being strong companies longer term. Question from Carl on the performance of our balanced fund versus Excel index balanced. Is there a reason for the underperformance? I'd have to look at the indexed return, the indexed product returns there to see what that's done and how that's traded. But there probably will be a reason for it. Yeah, I can get back to you on that, Carl. Look into that. Oh, right, so 100 years. Okay. We've got a question on currency risk generally. So we do a lot of work to think about purchasing power, like the value of currencies relative to each other, and how that, sometimes currencies can become overvalued, and sometimes they can become quite cheap. For us, it's a risk we manage at the edges. So you always, when you're looking at the company that you invest in, you think about where does it derive its revenue from, how does it hedge itself, and there are times when we would want to avoid certain currencies and shift the portfolio away. So you've seen that in the way we've sold out of things like Fresenius that earn most of their revenue in the US, and then bought companies that earn their revenue in Europe or Japan. So that should benefit from company strength there, for currency differentials there. When you go further and you start to say, okay, well, if you think that the dollar's going to fall against the euro, we could put a hedge in place there. You've got to think about, well, how much is that hedge going to cost? So if you want to shift your US dollar exposure into European exposure because of the interest rate differential, you have to pay a fee for that. And I think roughly that's about 90 basis points, so just less than 1% a year is the cost of putting that hedge on. So you have to have the euro appreciate by 1% just to make that trade worthwhile. And of course, it comes down to sort of three ways to do it. Are you trying to are you trying to speculate in the short term, in which case you've got to be right? Is it a long-term view which you're going to put on to change your currency exposures and just ride out whatever comes your way, in which case you have to be willing to kind of take that currency volatility? And then the third way is just to recognize that different currencies can move against each other, and make sure you've spread that risk out and you've diversified. So you have some exposure to the euro if it were to rise, some exposure to the dollar, so that if any one particular currency was excessively weak, that your portfolio isn't going to be overly harmed by that or overly influenced by it. And that's, I think, is the first approach we take, that diversification. And the second one is is something we might do if things got to extremes. Okay, look, questions in the chat now. So, okay. Oh no, there's something. Okay, there's a question about speculative proposed capital gains tax that would have an impact on target return portfolios if they go through. So long-term objectives will now not be reached as the ultimate cash out value would diminish because of increased taxes. I think it's fair to say that with government finances where they are and the large amount of government debt that's been introduced, tax rises generally are a risk from here. And capital gains tax in the UK, I guess is what the question's talking about. Capital gains tax in the UK is currently a very low tax. the people who pay capital gains tax tend to be richer people. And so when you've got that capital gains tax more advantageous than income tax, I guess the natural tendency of politicians is to say they could raise that to the level of income tax. I think that is a risk. For people with ISAs and SIPPs, clearly you'd be protected from that as it is. But for people with general investment accounts that aren't shielded from capital gains tax, this does become a risk to you. There's only two things you can do. You can either crystallize more capital gains tax now and pay the lower rate in anticipation that it might go up down the road, or you can try and not pay capital gains taxes by never selling anything, at which point your portfolio is going to diverge and become very concentrated in the winners, and the risk characteristics of your portfolio are going to increase, I would say, and become a little bit more erratic. So it's to some degree, it's up to investors how they want to treat that, whether they want to pay the tax now and at the risk of it might go up in the future, or whether they're happy having a portfolio which is constrained by those reasons. They both have pros and cons. Question about Brexit. It's all gone quiet on Brexit. How are markets positioned for a no deal, which is looking increasingly a possibility? I think one of the reasons we've gone quiet on Brexit is because all of the discussion around Brexit and a no deal was about how will GDP differ with a no deal versus a good deal, and all of the simulations that were put out there was, well, it might be sort of 1% lower for a period of time, or maybe 1.5% lower, and then it'll bounce back. Now that we've seen COVID wipe out 20% of GDP, in a year, it makes it it just puts that in perspective. COVID is 20 times as powerful as Brexit. So I think it's hard for the markets to take Brexit as a risk seriously when it's so dwarfed by the impact that we've had from COVID. But yeah, I mean, a no deal does look like a possibility. I think companies will adapt and deal with whatever the rules are, and if those rules are the World Trade Organization rules, that's what they'll be. The people have had enough time to consider and plan for it at this point. But as I say, I think it's dwarfed by the overall COVID risk, which is probably why it's not in the news as much. It's not like it's forgotten; it's just relatively less important. Okay, that's all the questions there. I realize there's a few questions in here that I probably should get back to individual people on, so I'll try and follow up with you for those more specific questions. Okay, thanks for dialing in, everyone, and we will see you for I guess December's update, which will hopefully cover a lot more positive quarter, or month rather. Bye bye.